Investment measures the physical capital, the equipment, and the structures being built in the economy. And following the financial crisis, there was the expectation that investment would come back really strong. That's what you would normally expect, because investment had been weak during the crisis, and so then you expect a recovery when interest rates are low and the economy is strengthening again. But over time, it became clear that investment was coming back in a very halting way, very slowly, and that's continued over more than 10 years since the crisis began. And that's worrisome because in many cases, that investment embodies technological change. So when firms buy new equipment, it has software loaded into it, and you get updates to the productive capacity of the economy through that higher investment and that new equipment that goes into place. But we haven't seen that. Increasingly, firms have been investing in intangible capital. You see more software, you see more patents and intellectual property becoming a larger part of what firms are doing. And that kind of investment makes up a larger share of the capital stock, broadly defined, over time, especially for the fastest growing and most productive firms. So if you look at the firms that are the largest and have grown very quickly, especially in valuations, like the tech giants, their physical capital really hasn't grown very much, but their intangible capital has taken off. So there might be a change in the structure of the way firms produce goods and the way they generate value that has shifted away from physical capital and towards intangible capital. The transition from an industrialized economy to a service economy has been going on for a long time. And firms have still continued to invest in structures, for example. So hospitals provide services, but they still need structures. This new change has been I think much more about technology. And we've worried that we don't see the effects of technology on productivity. We tend to see weak productivity. But we do see the effects of technology, at least on the investment side, in this increasing role of intangible capital. Weak productivity growth is one obvious explanation for weak investment, in the sense that if productivity growth is weak, then the return to capital would be lower. And so you would expect lower investment. So those two have naturally fit together, and that would be another explanation for weak investment. But the puzzle with the weak investment is that we see so much innovation. You have only to look at your phone and look at what firms are doing. And we see this growth in software and capabilities that firms have, and that's reflected in their very high valuations. So the firms are growing, but we don't see high productivity to match that. So the productivity remains an independent puzzle, and some of the weakness in capital may just be directly tied to that. But it's not an overall weakness in investment, because some aspects of capital, like software and platforms and patents and intellectual property, those have been growing very rapidly.